Good afternoon. It's Patrick Dwyer and Greg Poole here again from NewEdge Wealth. And today we have an incredibly special guest, Greg Blank, who is the CEO of Blackstone Infrastructure. And with that, I'm going to turn it over to my partner, Greg, to ask him his first question.
Yeah, well, we're really glad to have you here. I think infrastructure is something that our clients know we've been talking more about because it's really different than a lot of what they have in the portfolio. And it has some really interesting characteristics that we think are additive. Talk a little bit about how you define infrastructure and how you think about looking for infrastructure investment.
Well, thank you for having me. I would say at a high level, we have a very traditional definition of infrastructure. It's really about two things. It's about essential services and hard assets. I'd say each of those is really important to differentiate infrastructure from other asset classes. And let me just sort of spend a minute on those. If you think about first, essential services. So infrastructure powers our economy today, whether that's digital infrastructure, which is powering the modern economy. So think about every time you tap your phone, you touch an application on your phone that connects to a data center via cell tower and a fiber optic cable. That is digital infrastructure. That is powering the modern economy. You use it thousands of times a day, but don't think about it. Second, energy infrastructure. So what is that? That's everything that keeps the lights on in this room. So that's everything from power plants, renewable and conventional, transmission lines, utilities that serve your home or business, everything that does to basically power our economy with the electrons that run the world. And the last piece, transportation. Think about this as everything that's to get a package to your house from Amazon, or if you travel through an airport. And so I would say they have some very unique characteristics. These tend to be long-term contracted businesses. These contracts are for essential services where you have a contract before you build something. And I would say generally you have cash flows that grow with inflation. So you have explicit mechanisms in those contracts that grow with inflation. And so what this means is infrastructure has the potential to generate strong, long-term predictable cash flows. They grow with inflation and the ability to compound capital and grow those cash flows over time. And so at Blackstone, we're thematic investors. So we aren't just investing in the essential services today. We're trying to think about how that changes, how you look forward to that in the future. So we focus on what we call investing in the best neighborhoods. So we try to focus on these essential services, hard assets, long-term contracted cash flows, but in sectors where you have very, very strong growth for decades to come, whether that's the digital economy or parts of the energy economy.
I'm assuming the barriers to entry to these places I'm assuming are very high. Like it's just not easy to get into them. Could you just like pick one, like maybe data centers, which is like sort of a popular thing. It's probably over talked about, but just sort of like, what's the barrier entering the space? Why do you need to invest like long-term to invest in these asset classes? Explain that to us.
Sure. So if you think about like, let's start with what is a data center? So data center, it looks like a warehouse that you pass on the highway driving down the interstate, but inside it, it's thousands and thousands of computers. And what those computers run is the most advanced technology these large technology companies have. So if you pick whether it's Amazon or Microsoft or Google, these large technology companies, what do they do in a data center? They process the latest artificial intelligence software that they're running. It's their cloud businesses. So everything that powers the revenue of their companies. And so they need places that are completely redundant. They will never go down. They are mission critical to their businesses. So what is a data center? It's basically they're outsourcing the ability to run those. And so for us, what are we doing? We're leasing a warehouse for computers and servers that is many levels of redundancy to them so it never goes down. So what does that mean? We sign a 15 or 20-year contract with one of those customers. They're the best rated technology companies in the world. They pay us rent over 20 years to basically operate this facility. And so the growth in this is huge. And if you're a large technology company and you're outsourcing your most important software to these facilities that somebody else runs, you want to make sure that the person running that has a flawless track record of execution. And that's the real barrier to entry here is billions of dollars of capital to be invested, a flawless track record, and the trust and partnership of some of the biggest technology companies in the world.
So it's not easy to get in this space.
Not easy to get in this space.
And it's not the same thing. So when you think of like when investors come to Blackstone and they say, hey, I want to look at infrastructure, but they have equity portfolios and everything else. Why is it important that people allocate 6% to this asset class inside their portfolios? What's the real long-term structural reason why? What's the compelling reason why an investor should do this, in your opinion?
I think if you look at the characteristics of infrastructure, it has very unique elements that are different from everything else that they hold in their portfolio. And so as you think about it as an investor, you're looking to get a highly diversified portfolio that generates good risk-adjusted returns. And you're always looking to add things that give you different kinds of exposure that doesn't move in the same way the rest of your portfolio does. So if you look at infrastructure, I sort of coined this silly acronym for the characteristics of it. I say RDIY. So returns, diversification, inflation protection, and yield. I think those 4 key points highlight why infrastructure is something that's unique and really beneficial to portfolios. So let me just spend a few seconds on each. First, the R, so returns. If you look at infrastructure, it has generated double-digit returns over the last 20 years with 40% less volatility than the market. And so you have this asset class where through COVID, through the financial crisis, it's been incredibly resilient. It's been very consistent and it's generated attractive equity returns for 20 years through a lot of volatility. The second piece, the D, which is diversification, I can't emphasize this enough. What you've seen in portfolios in recent years is when things go up, everything goes up together. And when things go down, everything goes down together, whether it's stocks and bonds or different parts of it. So infrastructure, given it is more focused on mega trends and less focused on GDP this quarter, what's ever happening out of Washington this hour, the correlation of infrastructure to other asset classes, so the propensity for it to move up and down at the same time, is much lower than people expect. And so this is why the largest investors in the world are putting a lot more into the space. It enhances their portfolio and doesn't move up or down at the same time. And then at the last piece, the 2 other, the I and Y of DIY, the inflation protection, that's really unique to infrastructure. So these infrastructure businesses have explicit inflation escalators in their contracts. And so if you had to generalize, inflation tends to be good for infrastructure, which is not true of other asset classes. And then at the same time, it has generated a very consistent 3 to 4% yield. So those are the 4 characteristics that are very unique relative to other asset classes where people would have their money invested.
It's interesting, a lot of what we hear these days, especially in tech, is how little capital is needed to start companies. And some of these venture funds are having trouble putting their money to work. Infrastructure is obviously, the opposite. There's plenty of capital that needs to go. What drives that demand for capital in infrastructure, and do you see it continuing?
I certainly see it continuing. I think if you think about the mega trends that we're investing behind, we'll spend a second on a couple of these in the digital space. So this is really more software is being developed, more software is moving to the cloud. Artificial intelligence is going from a novelty on ChatGPT to something that fundamentally changes the way businesses operate. What does that require? It requires billions and billions of dollars invested in data centers to run that software. And so as we look at it in the data center space, there's probably $2 trillion of capital that will be invested in data centers over the next 5 to 7 years. $1 trillion inside the US, $1 trillion outside the US. So the capital demand is immense. So that's certainly going to continue there. If you look on the energy side, the dollars are probably bigger. If you look at US electricity demand, which has been flat for decades, we have an electrical grid that has been designed for no growth. Now you have electrical demand projected to grow 40 to 50% over the next decade. So again, 0 growth for 20 years, now almost 50% growth in 10 years. The amount of capital that's going to be required is estimated at $3 to $4 trillion. So more than data centers, and that's more power plants, more renewables, more transmission lines, more utility upgrades on the grid, more pipelines, more gas export facilities. Every part of that ecosystem is hugely capital intensive. And for us, that is the opportunity because we can continue investing behind these trends. And the same thing on the transportation side, which is our third sector, expanding our ports, upgrading facilities that are 50, 60 years old. Like the capital need is immense. And it's actually bigger than probably the capital we have. And so part of that is the marvel of infrastructure because the capital intensity is also a barrier to entry to the space. You have the inflation protection, but capital intensity, you basically increases the competitive moats around your businesses and something we find very, very attractive about the sector.
Can I kind of paraphrase that? If you build a railroad, no one's going to build one next to you. Is that kind of it for sort of the
I
philosophy?
think that's much better said. You build a railroad, nobody's going to build next to you. Nobody has an incentive to do it. So once you own these assets, you're always going to invest more money into your asset than somebody competing next to you with their asset.
Can you talk a little bit about like what does that look like from a return perspective? Like how attractive are the returns when you're adding on and bolting on to the existing investments?
Yeah. So as we invest capital, we buy a business and then we try to invest 50% more money in that business over 3 to 5 years. That money we invest into the incremental growth. So this is building new data centers, expanding our ports, adding new cell towers. That capital tends to be 40 to 50% higher returning than the initial capital we invest. And so it's an incredibly powerful flywheel, which is you buy a great business, you buy the number one business in an industry, it takes market share, it grows, it's capital intensive. Then you invest all this capital behind it to grow it. And that's really the power of how these infrastructure businesses can continue to grow and compound capital. And another way of saying, if you invest capital in the space, you can compound it very efficiently over decades as you're continuing to invest capital into these businesses to meet this huge demand for capital that's really only coming from the private sector.
I guess the big beautiful bill passed a couple of days ago, and I got a text this morning. My son is in the jet fuel infrastructure business, and he says to me, he texted me back, and he goes, "Dad," he goes, "the private jet market is on fire because you can fully depreciate everything 100%." And he goes, "And the private jet terminal market is going to be even more on fire because every one of our customers is telling us they're buying new planes. Like today, this is the first day, and this is the text this morning." So could you talk a little about aviation and your bets there and why you think that's going to grow?
Yeah, so we sort of have two bets in aviation. We own private jet terminals for private aviation travel in the US. So if I'm flying from New York to Miami, I get on Delta Airlines. Other people fly on their own plane or fly on NetJets. And to your point, that business, if you think about some of the trends, first of all, you have the wealth effect, which is a tremendous trend that we're all seeing, people continuing to spend money and things like that. And as travel has gotten worse, I was literally on a plane last night coming back to New York that landed at 2:30 a.m. I would have preferred the private option that wasn't delayed at O'Hare for 5 hours. But what that has translated into is more and more people flying private. The cost of flying private has come down. And so there's just been a huge continued growth. That's really just this continuation of this trend. So we like that private aviation trend. We also own some European airports. So we own the Rome Airport, for example. And this trend of travel and experiences has been a really good long-term bet. It's interesting. In the Rome Airport's history, I think 10 of its 10 busiest travel days ever were all in 2024. We could say that until like 3 months ago. 2025, I believe we've eclipsed that with 3 of them so far, and we're only 7 days into July. I think we will have the busiest travel days ever there. And it really just shows in these destinations where people want to spend on experiences, it's another way to play that trend. And again, you're doing it with us, with regulated or contracted businesses, which we really like.
One of the things I think is so compelling about investing in this space is, in the evergreen structures that are now available, where you have access to liquidity where you didn't before, you'd have to be in for 15 years, is that you can make an investment in this space, fully invested day one. You can add to it if you want to down the road, but you have cash flow. Like, you're getting paid. And if you're a patient long-term investor and you can let the investment compound, your cash flow should be growing just like the dividends on your stock portfolio from 10 years. So I feel like this can fit into diversification, but it can also fit into a client's portfolio. Clients are going to need cash flow retiring in 10 years. So I think it's very interesting from that perspective, like a real estate investment, but it has higher returns typically than most perpetual real estate investments. What's the downside? Like, okay, we've talked about how great it is, but like what can go wrong? Like what would be the reason somebody wouldn't want to invest in the space? What could be the reasons that things would go poorly?
Yeah. And look, this is obviously how we spend a lot of our time thinking about contingency planning in the world. And I would say the last 6 months, there's been a lot of complex geopolitical events that have sort of tested the durability of the world and sort of the space in which we play, right? You've had tariffs, potential trade wars, you've had geopolitical uncertainty, you've had inflation spikes around what tariffs do to inflation, you've had rates staying higher for longer, you've had a little bit of a slowing US consumer. And I would say, sort of as we look at all those, most of those aren't going to have a material impact on our business today. Because again, if you're investing behind mega trends, those are going to be less tied to what is GDP this quarter, what is the job report this month. Those are mega trend focused. But what you do have is, as we build more things, right? What is it required to build we build a new data center. We buy stuff from around the world. So supply chain complexity and trade is something that we do think about because Again, it's not going to impact our day-to-day businesses. But if I want to build a new data center and I need a generator from Germany and it's stuck on a ship because of tariffs, that's going to slow our business. It's going to slow the growth. It's not going to impact the day-to-day business. It's more, I can build fewer data centers this year than I could historically. And the second piece is we borrow money from banks and investors to finance some of these. And so to the extent there's a prolonged capital markets sort of volatility, that will increase our cost of financing and probably make fewer projects compelling for us. But again, it's very different than just GDP cyclicality, which you see in a lot of the rest of your portfolio. That's just something we worry about less. We worry about more idiosyncratic or macro shocks.
One question I like to kind of finish up asking folks, you talk to a lot of different investors. What do you think is most misunderstood about infrastructure investing? Do you see something that kind of consistently people just don't appreciate or misunderstand?
I think most people, again, I go back to most people don't really have a crisp definition of what it is. They sort of have a very vague definition. And then I think when you think about what these businesses are, we use them all the time. They are mission critical, but most of them aren't household brands, right? This isn't McDonald's. It's not Coke. These are businesses that, most of our businesses, if I put them on the page, you probably wouldn't recognize any of the logos, except you may have driven by one on the highway. And so in a very low understated way, they drive the world, whether it's the modern world through digitization, whether it's the energy or just things that we use in our day-to-day lives when Amazon truck shows up at our house and it went through one of our ports. But I think people sort of don't appreciate how many times it touches them on a daily basis, how mission critical it is. And then the first derivative of that is because it's so mission critical, the return characteristics are very unique, and it has generated more stable returns than I think people expect over long periods of time, even through COVID, through the global financial crisis, when the world went crazy in 2022 with interest rates and inflation. Infrastructure did exactly what it was designed to do. It's very stable and it has these predictable cash flows.
And so, we always talk about fees and taxes, and this is a tax efficient way to invest in a private asset class for an individual investor, and just makes a lot of sense to us. And I think the diversification is quite real. It doesn't look like anything else in anybody's portfolio. And so it's a way to get these types of exposures at what we think is the beginning of like a huge long-term trend change is the digitization and the reindustrialization of the United States of America is beginning. Thank you so much for your time today. Blackstone has been an amazing partner for us and for our clients over many years. And we were glad to be among the first investors in this vehicle, in your new vehicles, because we think they're really, really good. So thank you.
Thank you. And thank you for your partnership.